All right.
Welcome everybody to our halftime report. I wish we had not been as accurate in January as we said it was going to be.
Yeah.
That's kind of where we're at. Anyway, appreciate y'all watching. Appreciate y'all taking part in this. Will there be time for questions afterwards?
Yeah, we'll after we get done with the last slide, we'll hang out for a little bit. If anybody has any questions, we'll stick around to answer those. But yeah, I think we'll jump right in. Got a lot of information, got a lot of really great information tonight. So yeah, we'll jump right into it.
All right, our agenda, we're going to do a review of the first half of the year, which is somewhat distasteful. Our outlook for the second half and where we think our investors should be positioned for really not just this year, but probably for the first part of next year as well.
All right, so let's start off with first half of the year. Let me move this. We said in January that this would be the pivot year. You know, we've had a couple of really strong years, and the Fed was going to have to change their monetary policy, and that's exactly what we've seen happening.
Boy, did they!
Yeah, prior to, I mean, even before January of 2020 of this year, they were already stopping the stimulus that was going into the market every month. We started to see economic slowdown all over the globe, and labor markets being impacted by impacting inflation, stock prices. Everything sort of started slowing down at the beginning of this year, and unfortunately we kind of expected that to happen.
We don't really know excuse me, we don't really know how much of this is because of the COVID pandemic or how much of this is due to poor fiscal policy or how much of this is due to it's just that time. If those of you that listen to our podcast and our radio show know that we are unrelenting about a recession, inflation, all part of a normal process. We've gone 20 years without anything significantly bad happening, so to speak.
Yeah,
we're
well overdue for one.
Yeah, well overdue for one. So my sense is it's probably all the above. Probably COVID pandemic, poor fiscal policy from the feds, and
we were due for one. Yeah, we were just due for one, unfortunately. Yeah. And you know, earlier this year we talked about what a portfolio should look like this year. And again, I think all of that still holds true. What we've been telling everybody this year is that we're not seeking to get a positive return this year. We're in a very defensive holding pattern. You know, we're shooting for minimal losses. And unfortunately, it's just one of those years that I don't really know that it's possible to shoot for a positive return.
This is what the first half of 2022, if you look at the stock returns, bad.
Everything was down.
Across the board, bad. All the major segments declined. There was really nothing to write home about, with the exception of the energy sector. Energy sector was up 32%.
And if I was wondering about that, I guess it makes sense when you consider towards the beginning of this year, gas prices were skyrocketing, oil prices were skyrocketing. So it makes sense that that's the only thing that would be doing well this year.
Yeah. Now, one thing you might think about is, well, geez, guys, you're the geniuses.
Yeah.
So shouldn't I be in energy? Remember that every time we move money, you pay a fee, not to us, unfortunately, but to Wall Street. And so remember 2 slides back, we said we weren't going to chase returns. Chasing returns would be if you said, hey, get me in the energy sector now. Because by doing that, you'd be selling at a loss and buying at a high, which is exactly opposite of what you should be doing. Look at the bonds. Even the bonds are a disaster. I've been in practice 38 years, and I don't recall a time when the market and bonds were all losing at the same time.
Yeah, typically they have an inverse relationship where stocks are going down, bonds are going up. But unfortunately, with all the meddling that the federal government has done over the last 20 years with the stock market, and I mean, that includes the bond market as well, all of those indicators and trends have been thrown out the window. And you're seeing the result of that right now. This almost feels like an extreme correction where the market is trying to get itself back to a sort of homeostasis.
Yeah. Remember, the market's a living, breathing beast, and it performs best when it's left alone and not manipulated, as it's been happening for the last couple of decades.
Yep.
If you look at 2022 compared to 2020, 2021, Totally opposite across the board. Everything, with the exception you see of commodities, everything is losing money. Now, is that a bad thing? Yeah, it is. But we have said before that if you are George's age, if you're 20 years, 15 years from retirement, this is really not anything else more than a pain in the butt.
Then irritation. Yep.
If you're 3 or 4 years away from retirement, then hopefully you have repositioned yourself so that when things like this happen, it has a minimal impact on your retirement assets. Things like this is why we use annuities sometimes. It's why we back off to a much more conservative portfolio as you get closer to retirement, because we know events like this are going to happen. This is part of the natural economic cycle. We know it's going to happen. Perhaps not to this extreme, but the other thing to remember is that this is not as bad as it feels. If you compare this to other recessions, other inflations, this is not really all that bad. We are just coming off an extraordinary 2 decades of, not quite 2 decades, but of just unprecedented growth, and we've kind of got spoiled.
All right. Some of the reasons for why the market's been so weak this year: inflation, obviously, rising interest rates to combat said inflation, the fact that the whole world is struggling, the whole world's having a lot of slowdowns. Everything is valued much higher, and because everything's valued much higher, it can't go much higher, which means it can't go any higher, which means it's got to come down at some point. Geopolitics, again, a lot of that goes along with the global economic slowdown. And like we talked about earlier, COVID persistence,
Yeah.
not as much as last year, but we're still seeing some pockets of it. We're still recovering from it, and you know that's going to be here for a while.
If you look at the dogged inflation, it's interesting. Dogged inflation is combated by rising interest rates. We'll talk a little bit more about that in a minute. But the inflation is caused by the high asset valuation, stocks, bonds, real estate. Everything is priced ridiculous.
It's like a domino effect. This list is almost like a domino effect.
Yeah, I mean, if you've looked at real estate just in Greenville in the past year, if you list a piece of property for 300,000, it's going to go for 350, and it's going to be gone in 2 days. Now, the last 60 days with the interest rates going up, we've seen that slow down dramatically, and the real estate market is slowly but surely starting to get back to where it needs to be. One of the things that I think we need to recognize is that we are not and have never been a $35,000 Dow, 35,000 point Dow economy. That when the market was at 35, 36,000, that was a false reading. We're not that good. I mean, no one is. No one in the world is. And so when the dust settles, be prepared to be in the high 20s, which is still, in my opinion, a little bit too high, but it's more realistic. We are literally experiencing the burst of a bubble that was caused by COVID and by federal economic policies.
And speaking of those policies, the biggest reason for weakness in the market is the end of what we're calling the Fed put. What that means is that the Fed put was the belief that the Federal Reserve Board would dump money into the market if it dropped too much too quickly. What they've been doing for 20 years. That didn't happen because at the beginning of the year, they finally realized that inflation was an issue, that it was not transitory, and that they needed to do something about it. And so all of their focus shifted to fighting inflation, which means that people became a lot less risky with their portfolios because they weren't confident that if the market went down, the Fed would step in to fix that.
Biden actually announced in the fourth quarter of last year that they would no longer be putting the billions of dollars into the bond market. So we were kind of prepared for this. We were kind of anticipating a drop in the market. And again, this goes back to the policies that began approximately 20 years ago, where the federal government has manipulated the market instead of letting this do its own thing. Now, there's some argument, oh, that's a good thing because during COVID, the market would have tanked. Maybe, but what we're seeing now is that all of this artificial prop up has to be weaned off and allow the market to recover back. Now, the question is, will they continue to do that? Will they continue to leave the market alone, let it get back to where it needs to be? Will there be Yeah, my feeling is they will not. At some point in the first quarter, second quarter of next year, they'll start putting money back in.
Hope not.
Yeah, we hope.
Yeah.
All right, second half outlook. Well,
I don't, this is one of the few slides in this presentation that I think I disagree with.
I don't think we're in a recession. I know we're in one.
Yeah, we are in one. We have been in one. Nobody wants to call it that. I do agree that reading the economy has rarely been this difficult. That is true because again, all of the indicators that are there that were there have been totally thrown out the window. The book has just been thrown out again because of this artificial prop up, because of the meddling of the federal government. None of the tried and true methods of measuring the economy are accurate anymore. But I disagree that maybe not we're in a recession. We're in a recession and we have been.
I think the world is. I mean,
It's not just us. It's the world. That's typically how it happens. The world goes into a recession.
Not that. Look at the next slide. Look at the next slide. The four major economies, United States, China, Japan, and Germany, are all dropping. Now, those four countries are 50% of the world economy. And you see that on this graph that we're all dropping like a tank. So it's not just the United States. But let me again emphasize, because this is really important for me that y'all understand this, for us that y'all understand this. This is not the end times. This is not your retirement is gone. This is not your financial plan is shot. None of this is true. This is a normal, albeit painful, part of an economic cycle. Those of you that have worked with us, we have been prepared for this, not for this specifically. But this is why we use a 6% return when we're doing planning, not 9 or 10. This is again why we use annuities sometimes. This is why we have money in different places, because we know that during your lifetime, there's going to be a time like this. So with those of you that are close to retirement, don't panic. This is not going to impact you. It may impact you today because you see your portfolio is going down. But remember, what we're doing is a long game. It's being played over your lifetime. So don't let this panic you. Don't let this go, man, we've just really made some mistakes here, because we have not, and you have not.
All right, you can see here there's a lot of uncertainty. Let me move us real quick. There's a lot of uncertainty around a number of things, monetary policy, national security, and recession obviously is the biggest thing on people's minds. And again, a lot of what's happening in the market is a direct result of this uncertainty. People's perception of the market is what drives a stock market up or down, because there's a lot of uncertainty with recessions right now. With all you hear is that, oh, a recession's on the horizon. Because of that, that's got a lot of people scared, which means they're pulling back from the market, which is drawing the market. It's helping to contribute with the market being down.
Well, when you have as little confidence in the government and in the media, that our source of information as people seem to have now, it makes it even harder, because when we're getting the information out, it's still not necessarily believed.
It's not a complete picture.
Yeah. Inflation, major concern. This is Alstar Inflation Index with levels not seen since the early 1980s. Now, I was in college in 1980, 81, 82. That was the Jimmy Carter years when the prime was 18%. Inflation was sky high. That makes what we're going through right now look like
a walk in the park.
Yeah, and that's what I'm telling you. Is this is not like, oh my God, this is the end time. It's not. We got through the Jimmy Carter years. I do not think we're anywhere close to being in the 18% prime interest rate. Would not surprise me to see right now we're like 2.5 in the prime. Would not surprise 4.5 prime, which would put mortgages somewhere in the 8 to 9 range probably.
Yeah, what this graph is showing is that part of what this index is measuring is the height and how deep it's entrenched. What this is showing that inflation is high and it's pretty embedded in the U.S. economy right now, for a variety of reasons. I'm just beating a dead horse at this point, but the inflation, what this is showing is that inflation is pretty entrenched into the U.S. economy, so it's going to continue for a while. We've got some pain before we get through this. That's what this is showing.
Yeah. Now, what the feds are trying to do is what's called a soft landing. Now, remember that with the Federal Reserve Board, when they are charged by Congress to do two things. One is to keep inflation 2% or less, and number two is to keep unemployment low. Well, those of you that are my age, old cooch like I am, you remember back in the 80s, again, when we had the Carter issue, Volcker, who was the chairman of the Federal Reserve Board at the time, let unemployment percent because he jacked the inflation rates up. Look, 20% of the time they pull it off a soft landing. It doesn't happen very often because it's very hard. It's very difficult.
Yeah, because I mean they're balancing a national economy. This is not an easy task here.
Now, some optimism. We've got the lowest unemployment in 50 years, which means I think it's 3.5%, which means they've got a lot of wiggle room to raise interest rates.
Yep. And again, a lot of another reason for optimism, stock valuations, they're much more in line with where they should be. Again, along with real estate, along with everything, last couple of years, everything has been so high. I mean, the value of stuff has just been so inflated. Now that we have inflation, now that all these things are happening, that's helping to bring these prices down to a much more stable level. So when you see the value of a stock or of anything, it's much more in line with what it's actually worth instead of 25, 50% above what it's worth. So it gives you a better idea about the strength of a company or a piece of property or whatever.
And I can read your mind. You're going, that's all well and good, but that doesn't help my portfolio. And I'm almost to retirement, or else I am retired. The fact of the matter is, it does help your portfolio because it's making it real. Remember that what we do is, it's not for the next 5, 6, 7, 8, 9, 10 years. And those of you that are with us, I may be wrong, but I can't think of anybody that is positioned in such a manner that this type of market would put off your. But what it should, then I promise you, once we get through this, and I think that part of the economy will settle. It'll be a much more stable. Like me not eating pizza anymore in the long term.
But I think they may be a bit too optimistic with that 3.4%.
But there's two good things to say about this. Number one is that the feds are now saying that they think January 2023 will be when the rate increases stop.
That was when they peaked.
So that's kind of a light at the end of the tunnel. If you'll notice then, fairly quickly after that, based on this graph, the interest rates start to drop. So I think once we get through the first quarter of next year, things are going to turn. Now, I do not think we will ever be back at a 0% prime rate. I hope we never are again, because that was the beginning of this debacle.
That's what got us in trouble to begin with.
Yeah. When I was a kid growing up, a mortgage was about 6%. That was considered to be a decent mortgage. Everything worked good back then. So I'm not sure we'll ever see a 2.5% mortgage again, but I don't want to see an 18% mortgage rate again either.
Again, this is all a balancing act. We're trying to find a happy medium somewhere. All right, and we're gonna hit our last point. How should you be positioned as investors? What's the goal here? So these are the known variables for the second half. The stuff that we're kind of monitoring is, will the Fed be successful? All right. Strength of the labor market. Will it continue to stay strong? What kind of impact will these rising interest rates have? And then the last one, persistence of inflation. We know that it is here and it is deep in the economy. So we know that those factors are going to be impacting the second half of the year when it comes to the market.
But hold on one second.
Yeah.
But remember that if you have done the appropriate investing, the appropriate recalibration, none of this, and I know I'm beating a dead horse. I know you're all going, but it does matter. It does not matter long term. The Feds will be successful. It's just a matter of how long it will be. The labor market may fall. If it does, it will come back. Inflation may go down. It will come back again in the next decade. So the variables that we're talking about are always here. And if you have positioned yourself appropriately, this is it's a grain of sand in the eye. It's irritating. It's snot. It's debilitating for the moment. It's not a long-term disaster.
The nice thing about these variables is, again, that they are known. There's something there. We know that they're going to be an impact. And so we can kind of track them and monitor them based on what's happening with those variables. Then we can make a prediction. So we're not totally flying blind here, because, again, this type of thing has happened multiple times in the past, and it will happen for multiple times in the future. So we have a history on how to handle this.
Right.
So again, there is some comfort there.
Now, where the Fed screwed up is, you remember last year they were going, the politics, went out over common sense, and they were saying that inflation was transitory. All right, that hurt them big time. Number one, we should have started raising interest rates in May of 2021, not May of 2020. And number two, it really called into question whether or not the Fed's, the administration had the backbone to do what had to be done. They have to get control of this inflation narrative. When their talking heads come on TV and say we're not in a recession, inflation get under control, that drives me insane. Fortunately, the Federal Reserve Board, even though they're being very aggressive, is moving to reduce inflation. The higher the interest rates go up, the less money there, for a variety of reasons, the less money there is in the economy to spend. And that's how you slow down a red hot economy. So they're doing the right things. I just think they waited a year too long to do it.
Yeah, and by waiting a year too long, all they've done is extend the pain that we're going to be dealing with, because it's going to take that much longer for inflation to get under control, which means it's just going to last longer.
And it's kind of like total morons last year saying inflation is trending.
Yeah, that was, I'm not an economist, but that was the dumbest thing I've ever heard in my life.
Even though fat boys are all just like that.
Yeah. All right. Second variable, strength of the labor market. Employment is the wind in the economy. So I really like that analogy. That's the employment is what keeps an economy going, because, again, obviously employment is what drives production, which is what keeps an economy going. Right now we're in a slower economy. So the fact that we do have a strong labor market can be kind of a boost to what's going on. If we've got a shallow recession, strength of the labor market should persist.
That big old blue one, how would labor respond if deep recession materializes? That's a concern.
It is.
Because
that's the big question.
Yeah, if we have a hardcore recession, I don't believe we're going to have one.
No, I don't
if,
think
if
so.
we had a hard one, then you would see layoffs. And remember that part of the Reserve Board's responsibility is to keep employment up. So if you start seeing layoffs, they would probably have no choice
but to
drop interest rates. So that's that soft landing we're trying to do. I don't think that's going to be a problem. And even if we have a deeper recession, I don't think there'll be any layoffs anytime soon, because there's so much inventory that we don't have that we need to have.
And again, we still have a lot of wiggle room when it does come to unemployment. It's not like if we do have a deeper recession, layoffs happen, we're going to have to start dropping interest rates immediately. There's still some. So again, not something that we're deeply afraid of, but it is something that is the major concern with the labor market, something that we're aware of. And again, it's a variable, so it could happen. Just something we're keeping in mind.
Yeah. Inflation, it is the largest single factor in capital markets. We're not used to it because we haven't had one for 2 decades. Will supply bottlenecks open? We think they will, for the simple reason that people are not buying stuff. And so things are slowing down.
They can get caught up.
Yeah, and they can get caught up. Will it respond to declining aggregate demand? In English, that means, are they going to drop their prices? And I think that will happen too, because I think you're going to, 6 months ago, you went by a car dealership, there were no cars on the lot. I think a year from now, you may go by and there may be cars parked on top of cars because they can't get rid of them. That will drive prices down. And hopefully that will encourage people to get back in and start spending. But that's literally why you raise interest rates. You're trying to drive prices down, slow slow spending down, so it will drive prices down. There's also some interaction with the way the banks loan money to each other. But by and large, a high interest rate is designed to slow everything down and let the economy catch up to the demands of the people. Now, until this happens, markets are going to stay choppy. I think the worst is behind us. But even in the first quarter of next year, if we woke up to a 1,200 point drop one day or a 500 point increase one day, neither one of those would surprise me. I think overall we're past the worst part, but we still got a lot of this coming to it.
Yep. All right. So second half, how do you position? And how are you positioned? So will markets go up or down for the remainder of the year? Like we just said, we don't really know. But that, I would say, in any year, not just a year like we're having this year. Last year, I would have said, I think they're going to go up, but it's impossible to say. Remember, guys, the point is that the goal is not to time the market. It's to make sure you have the correct amount of risk for your situation. If you're working with us, we've already done that. When we build up your plan, the whole point is that we're putting you in a position that's going to last your lifetime. We're not trying to jump on the latest trend. We're not trying to time the market. We're not substantially changing the risk that you've got in reaction to the market. The reason is because when we first started working with you, put a plan together, we decided with you what risk you needed to take for your lifetime, and that's what we put you in. And so the biggest thing is don't react to the market, because again, that costs you money, and if you're reacting to the market will win every time.
Asset allocation is the most important thing that you've got going on right now. That's why those of you that are closer to retirement, we may have moved some of you to some guaranteed stuff. A lot of you are in the 50-50 mixture where only half of your assets are exposed to the market. Time in the market, not timing. Nothing has ever beat the return of the stock market over your lifetime. So don't focus on the next 6 months, year, but focus on the next 30 years of your life. All right. Investing involves trade-off. Obviously, that's the case. Pay attention to the controllables. We're still seeing a lot of people that come into our offices, that are new clients, that have absolutely no clue what their expense factors are like, what their tax situation is. You can control your spending habits. You can control, to a certain extent, your taxes and where your assets are at. Build your core portfolio. That's what you paid us to do, is to have a portfolio that is sufficiently diversified that markets rise or fall, it doesn't make any difference. I know this hurts your feelings right now, but long term, this will not hurt you one bit.
And that's the biggest thing is to remember that investing is a long-term game. We're not worried about this year. We're not worried about next year. We're not worried about 3 years from now. We're worried about your lifetime. When we're talking about investing, when we're talking about a plan, we're looking long-term. And so don't get so caught up in year to year that you forget the big picture, because again, that's the whole point of the plan, is that's big picture.
Well, this is the important disclosures here. You really must read all this because it's very, very important.
This just talks about what geniuses we are. Really don't read too far into it. I just summarized it for you. Definitions. All right.
This is us.
Yeah, this is us. This is our disclosure. And now we'll hang out for a little bit. If anybody's got any questions, fire away.
And please remember who you're dealing with, so make them reasonably simple.
Yeah, 1-syllable words, not too many words, otherwise we'll get upset.
Yeah. So far, we must have done such a magnificent job.
Explaining everything. Yeah.
Either that or everybody cut us off.
That could be it.
That's a possibility.
Yeah.
Give a couple more minutes. Again, if you want to ask us a question, just type it in under the chat bar and it'll come up and we will read it out to the other two people listening.
And depending on if we like the question or not, we may or may not answer it.
Yeah, we don't ask any personal questions because we give personal answers.
Yeah, we'll answer it. Yeah.
Right.
Yeah.
And that's it. We appreciate y'all listening. Tell your friends and family this is going to be a podcast format, YouTube format, whatever. But anyway, it'll be out there if you want to take a look at it. If you have any questions, call our office. We're always ready to chat with you, and we appreciate your time tonight.
Yep. Yeah, I'll have a good evening.